Just a second. Yeah. So we're recording this session. Hi everyone, this is Dhruv from 256 Network. We are back with the second edition of our Family Office series. Hope you liked our previous one. The recording of that session is on our LinkedIn page. So just a bit of background for people who are new to the network in attendees. So this is one of the private capital investor network which we created in the last 1.5 years. Idea is to get capitalist community across 6 asset classes investing in Indian market. And in the last 1.5 years, we managed to pull 415 GPs and LPs globally investing in India, and tapping 18 countries. And in last, we have done close to 21 gatherings across the planet, this is mostly a member invite sort of a network. So this family office series, we are making it sort of a public. Though in this session also, we have invited mostly members and select people from the outside, mostly family offices, and which we feel because that the session is for them to spread an awareness around that. So idea was the objective of catalyzing new family offices to venture into investing in tech. So the network is conducting this series of sessions with other prominent family offices, VCs, and institutional investors. And mostly the sessions aim to address often untouched areas of relevance and deep insights from relevant experiences into the benefit and opportunities, friction and challenges, solution know-hows of traversing investments in Indian tech. And in this session, we'll be deep diving into selecting the right VC for your family office. The session would be led by Chirantan Patnaik. He heads venture capital and co-investments at CDC Group, which they've backed more than 30 funds in India. The session would be moderated by Sudhir Sethi, founder and chairman Chirate Ventures, and Rajan Navani, CEO of Jet Synthesis. So over to you, Sudhir and Rajan. Before we start, I request everyone in the audience, they can start posting their questions on the Q&A tab. So in last 20 minutes, Rajan and Sudhir can pick and select those questions and uh, address those. So over to you, Sudhir and Rajan. Thank you.
Okay, well, thank you, Dhruv, for inviting us here. And it's rare to get Chirantan talking about topics which are very, very important to pools of capital in India. I think the first thing is that, there is generally thought about that India itself does not have capital or does have very little capital. But fundamentally, there are family offices, there are large institutions which have enormous amount of capital who have started to invest in venture and private equity. And we thought it a good idea to invite Chirantan, who looks after India from CDC. I've known Chirantan for a little while and extremely knowledgeable about a topic which he's going to speak about right now, which is if if a family office wishes to look at the asset class through a venture fund, then how do you select one? And is there a science behind it? Is it voodoo, or is it a combination of both? So, in that context, I'm going to hand over to my co-moderator, Rajan, and then Chirantan to present the methodology. Rajan, would you like to share how the methodology will be?
Sure. Thanks, Sudhir. And it's a pleasure to be here with Chirantan, Sudhir, and a nice informal network that Dhruv and others have been able to build to honestly, frankly, transparently share different insights, make a conversation. So I think the key thing is we'll try and keep this as conversational as possible, as an open conversation amongst friends. And I think I'll try and add, the perspective, particularly from the family office side, really, the journey and the reasons why we as a family office, make investments in venture funds, really what's some of the driving thought process, there? Is it more to just learn and understand or really increasing one's yield and really looking at different aspects? And I'm sure we'll have a great conversational session. What we probably like to do is as we go through, Chirantan would make a presentation. He's got some powerful slides that will enable us to focus on subjects and topics that would be relevant to both family offices and venture funds. and really see how we can, bridge this the link between the family office, the venture funds, and hopefully by the end of the session, be able to bring in a deeper level of confidence in each other to see how we can, over a period of time, particularly for a country like India, where the risk appetite of family offices investing in venture funds is really limited today. How can we really enhance this, build a great trusted network and ecosystem that can strengthen this movement as we move forward? So as Sudhir said, Chirantan will talk on some slides. We'll pause after maybe one slide or two slides, make it again more conversational and try and see if we can bring out all the thoughts that are there in the minds of all of you who have joined this session. And as Dhruv mentioned, you can keep posting questions and we'll find the relevant point to bring some of that out as well. So should we hand it over to Chirantan now to get started?
Chirantan,
yeah, sure.
Yourself
hi. Just checking if I'm audible.
Yes.
Thank you, and thank you for the opportunity. There's clearly a lot of expectation, and it's only going to be downhill from here. So I hope not. But just a brief background. I'm part of the CDC group. We're based out of London, but we have quite a large regional presence in India. A very strong team there, who where we are trying to kind of do a lot more in the South Asia region. And my role, in the team has been for a couple of years to look at venture fund investments, as part of a broader team who looks at general PE investments in India. And so, I think what I will kind of try to do today is to just give a perspective, right? Just give some insights, and I'm sure there are people who have different kind of data points there, but just of how we look at it. CDC is a development finance institution. We invest in India because we want to kind of reach the underprivileged. We want to reach invest in companies that have a reach to lower income consumers. So. And where VC fits in that is that it is a disruptive model, which in our times especially, where you can reach a mass to give affordable goods and services to the masses in really innovative business models. Now, so as a firm, and I'll talk about how people should think about this more strategically. As a firm, we've decided that in the very early stage, we will look at venture funds. And then kind of move on to back some of the most development ones as co-investments, and then of course look at it from a direct equity standpoint. So strategically, that whole chain flows. But what I'd like to do is, I guess, just for the audience, kind of really bring to the fore the whole point about why venture capital and why India. So I'm just about to share my screen. Can everyone see this?
Yes.
Yeah, perfect. So this is an LP's perspective on the VC asset class. And essentially, what we're trying to say here is that VC as an asset class is quite an important catalyst, right? Because what do VCs do? They invest in companies which can achieve rapid capital efficient growth, build businesses which are asset light, instant reach to masses over a very short period of time. And we have quite a few examples in India and in the region for that. And this has been, it's not just anecdotal, it's actually been researched by a gentleman called Josh Lerner from HBS, who kind of wrote a very interesting piece on why policymakers should care about venture capital. Because as a tool, venture capital, has a very efficient and exhaustive screening process, right? So not every great idea out there is worth investing. And, I'm sure each one of the people, even in the audience, they hear about a new startup which is trying to disrupt it. But how do you really understand, what is actually good and what is not so good, or what actually has legs? So that screening process is what VCs bring. And of course, even in good companies, it's all about when to give the right amount of money at what time. So the whole tranche-based funding based on performance metrics, and the whole kind of understanding the future applications on technology. there is a lot of support that VCs give to these firms, and there are two schools of thought here, because one school of thought will say, actually, you just back the best founders, right? A job of venture capitalist is to identify who are the right people and just back them and let them do their thing. But there is a very large element of advice, guidance, strategic kind of direction, which seasoned venture capitalists can give, and it will be interesting to hear from you, Sudhir, and how that journey has been, and what your investees think of that. And this chart below I found quite interesting, in the sense that it really split out between a VC-backed company in tech firms and non-VC backed, and the time it took from their founding date to IPO. So clearly, you can see that it can kind of rapidly gain scale. It's interesting.
Chirantan, maybe
yeah, sorry, go on.
I'd answer your question. I think fundamentally there are two questions. One is the Indian, why India? And maybe I can address that first a little bit. We believe, and this is as a VC, and our LPs do believe, and you're one of our LPs, that there are real problems to be solved in India, which have not been solved before. And fundamentally, technology can solve them. They cannot be solved otherwise. I think there's a very fundamental premise on the basis of venture capital fund is set up, or a group of people who are set up. This is in the supply chain issue. This is in the distribution chain. This is in solving or getting health delivered to 1 billion people down the line, getting the whole space of finance being enabled for 1 billion people, 300 million SMEs in the country, and the list goes on and on. So fundamentally, I think venture investing is about solving very real problems which have not been solved before. And that's where risk comes in overall. And that's where it's a bunch of experts potentially, which an LP, which may be a family office, hires because it's possible to get outsized returns from it.
Right. And exactly, thank you, Sudhir. And that's what we've seen in India, right? We talk a lot about all the stuff that's happening outside, and when we started looking at it at this segment for I think back in 2016-17 as a team, we started seeing some trends, and I just wanted to kind of point this out here. I mean, this may seem pretty self-evident, it may seem pretty obvious, and this data is only till 2016, but this is what was happening. You were seeing a majority of the deal flow which was happening, right, in private equity, venture capital, early on was the traditional sectors, right? Whether it's consumer, ag, education, energy and infra, financials, hospitals and things like that. As a share of volume, that consistently started falling, and you saw new tech-driven segments kind of emerge. So, VCs were catching on to that, right? This is one of those kind of signals. They were catching on to that. They were trying to back some of the emerging tech-driven segments. So, you have an agri company, but you also have an agri-tech company, which is probably a digital twin. You have healthcare, and then you have health tech. Do you go to a hospital or do you go to where the patient is, which is online, right, on a mobile phone? So, so that has, those have grown, and VCs have really kind of backed onto that. So if you really break up this whole segment of deal flow, that's where we see some interesting trends, and that got us interested looking at the space initially.
Chirantan, even from family offices, often we find that the next gen, the key word that drives the next gen is this word tech at the end, right? And I think because it spells disruption, it spells something that the next gen feels native to, and the older generation, from family offices are often considered, not as good in tech as the next gen typically is. And I think that very often, sets the trend for, angel investments, etc., happening from family offices initially, and then, of course, maturing to more calculated bets, as the opportunity to be able to learn and understand increases, through that. Like in our case, while we are a 81-year-old third generation family business, which was in traditional businesses out of Thailand, textiles and packaging, part with the Aditya Birla Group and all in the 60s and 70s. When I was, a couple of decades ago, looking at, where do the new opportunities and growth areas lie, took a bet around tech and leveraged our investments as LPs into VC funds, etc., globally, because our family office was based overseas. And now, actually leveraging that knowledge to build operational businesses for the next 20 and 30 years, which have tech as a core piece of that pie. So I think there is an opportunity just around that word, and I think there's so much that India is going to be able to bring to the table as we move forward. So just wanted to add that one point.
Thank you.
Yeah.
And Sudhir, this is also, your would be interesting to hear your view on this, because there was a dot-com boom. Let's not forget, right? There was this whole euphoria earlier. There still is. What is a unicorn after all? It's somebody, some private market part, pricing things. So, do you see anything different when, I guess, in the past and what you're seeing now? Is there anything fundamentally different?
No, I think between in India, I would say VC 1.0 was 98, 99, 2000. And at that point of time, a few businesses, today they exist as Naukri and a few others came up. They basically were built on solving problems in the internet startup side, where the number of internet users in the country was like 10 million. And so fundamentally this, it was scaling was difficult. However, at that point of time, I would say that whatever came up was clearly copying what was there in the US at that point of time. I think this was 100% clear. The next one was that, let's say VC 2.0. I think that started in 2006-7 when local models came up in India, solving problems predominantly in the e-commerce space. And e-commerce to me is solving the challenge of delivery of the right product at the right service of the right quality with predictability. Okay. And that fundamentally did not exist in the country. And e-commerce enabled that across the country. And so effectively it brought services and products to homes. And that was, I think was big, because initially it started at 10 to 20 million transacting consumers and then became today 100 to 120 million transacting consumers. And then brought scale to it. And subsequently now we have everything under the sun, because for the first phase of life, VCs were investing in, let's say, the last 10 years on the first 100 million consumers who possibly could benefit of it. Whereas in the next 5 to 6 years, we are investing in companies which could reach out to 400 to 500 million people. And that's a very big difference. That fundamentally means that the best is still to come.
Interesting. And, this is what, again, going back to that, we found something different here. And when I say we, it's not about like the first ones to do it. I think we're just like trying to understand as a development organization, why it matters. And I'll get to that in a later slide. But, again, when you had all of the VCs kind of putting in money, backing companies, you also saw all of this leading to some of the fastest, what are called, unicorn valuations, right? The average time, it's a very interesting chart I found online. The average time to get to a unicorn status is about 7 years from the date of incorporation. And, you can say a lot about, well, is it really that valued? Is it really a $1 billion company? But the fact of the matter is, it has scale. All of these companies have done something, disrupted a business, disrupted a segment, have had reach, which traditional business couldn't have had. And so from an investment standpoint, if you look at as a family office, right, you're starting to see these companies in your organization, in your sectors, really become valuable really, really quickly. And you'd want to kind of understand why that happens.
Yeah, I think here, if I may add, Jonathan, it's very interesting. First and foremost, there is also one misnomer that returns in VC funds are only by $1 billion valuation companies. I think so. I want to just correct that.
Yes.
That as a practicing VC, many of our returns have also come predominantly from valued companies anywhere between 100 million to 400, 500 million. valuations. But the point here, I think you're trying to make, and correct me if I'm wrong, is venture investing allows or facilitates a company using technology to grow rapidly, which could not happen before. So effectively, if a traditional industry in the food business took 25 years and 30 years to scale to certain revenue levels, technology in with a business model change and a revenue model change will facilitate that perhaps in 7 years average, as you have said. And that is the difference as to why technology. And maybe I can
Hmm.
invite perhaps a comment from you, that is the connection between venture and technology very hard and very strong? Because to me, that is the enabler.
Yes. Yeah, I mean, it's quite clear because, again, asset-light businesses, rapidly scaling, need capital to, essentially grow. There is, what you call some periods where it will burn cash, etc. But the market is there. It's out there. You can kind of, with decent unit economics, kind of make a business, right? So, as a funding tool, I think who would know this better? I'd say a venture capitalist rather than a traditional private equity investor. Now, I don't want to kind of make that very distinct differentiation to say a PE guy cannot understand this, or a VC guy can understand PE, but it's that whole DNA, right? That comfort with pre-profit businesses, that comfort with rapid scale, and that ability to I think, and that's less of science, but ability to really look at the founder in the eye and understand and make that judgment, right? Which is very hard. I thought, it's not stuff you can say at an investment committee, right? That yeah, the founder has it, right? It's a very subjective thing, which I guess plays a lot in your world, Sudhir.
No, absolutely. And I think one comment, and again, both Rajan and Sharanthan, is when, if you look at the kind of businesses which venture backs, I mean, I'm today talking to entrepreneurs in the age group of 23 to 30, 35. Okay. And there is the big difference, because that's where innovation, understanding of technology, agility, rapid growth, and ability to be comfortable with uncertainty is extremely high. And these are not intergenerational entrepreneurs. They are all first time, maybe at best second time entrepreneurs. There's no legacy of hand me down from father to son to father to daughter. And would you like to comment on why innovation takes place here and not in traditional businesses as such? Because that's what venture backs: innovation with young entrepreneurs, etc. Something to ponder about, Chirantan and Rajan.
I think I mean, it's a very valid point, right? Because I think your ability to take risk really starts when you don't have anything, right? I mean, many times when you look at family entrepreneurs or entrepreneurs coming from the family generation, I'm just trying to put that, the conversation within the family is, you're a trustee of the wealth that is being passed down, for generations, right? And I think typically the risk-taking appetite of a family office or a family business office has been, okay, in our business we are taking risk, we are investing, but the money that goes into family office is less risk averse. It is more like generational wealth that needs to be passed on. And I think that is the fundamental challenge that we have in being able to attract enough HNI capital and family office money into the VC world. But I think increasingly, as I mentioned earlier, people are beginning to recognize the risk-taking ability of great founders, and I'm sure that the the scale at which this will grow from here on is very significant. But on this slide, like typically a family office would ask, while you say it takes 7 years to get a unicorn, but what percentage of companies really become unicorn, right? I mean, what is that number? And most family offices, when they've invested, say, many have, I wouldn't say most, but many, have not got the expected returns from a VC fund. Then you say, like, do I need to invest in multiple VC funds to be able to generate a return? or how do I really look at my portfolio? So I don't know, Chirantan, if you have.
Yeah, no, interesting, and there's a reason I brought this slide up, because I hate bringing up stuff on unicorns, because look, it's a media term. It's a sometimes a badge of honor to reach that $1 billion thing, and it distracts you from actually the hundreds of other companies, as Sudhir mentioned, who are generating value. They may not be $1 billion companies, right? And this just kind of gets to the fore that actually in India you're seeing them reach a level which you're seeing in other parts of the market, in whether it's China or the US. And this slide I wanted to spend some time on, because it's not just, and these are basically investments and exits in the VC space in India. It's not that it was only investments that were happening. There were cash exits, right, happening across the spectrum, whether it's consumer companies, whether it's B2B SaaS companies, or any of the other companies that VCs back. There has been exits. So I think it's one of the misnomers that there's a lot of money in, there's all promise, but there's no return. Yes, of course, if you look at the entire chain, it is a high risk, long tail business, and it's not, returns are not normally distributed, but there have been significant returns in this industry as well.
And Chirantan, if I may ask you, venture asset is an illiquid asset class. We have almost 50% of our funds raised from India, from Indian families. Now, typically the questions being asked are, because it is illiquid, and illiquidity means anywhere between 6 to 10 years, right? That's the fund life which is there, which I know you're covering later. But from a returns perspective, have VCs in your portfolio globally or in India delivered more than, say, public markets? Because public markets are liquid. And is that a very important factor, Rajan, from a family office point of view?
I'll make a quick comment there on, yes, as a firm, CDC had been investing in the past in markets like China, and there has been significant return that CDC got from those investments. They were venture investments at that point of time. So just as context to the audience, our geographic mandate right now is South Asia and Africa, serving the kind of relatively poorer parts of the world, so to speak. But when we did China, ages ago, I think the idea was there to capture as much of the growth that came in from early stage companies. So the VC fund returns in China are just amazing. We joke that's what kept the lights on for CDC for some time. But yeah, there has been really good returns, and these are companies which are are big names right now globally, but from China, have manufacturing units in India, and maybe that's what we're going to see in India. Maybe we're going to see those companies built in India, expand into other parts of the globe, in our regions, in South Asia and Africa. And that's another thing we like to look at.
And just to your point, Sudhir, it's a very pertinent subject, right? Because when we really look at equity as an asset class and within family offices, the discussion is always like, how do we time the market correctly, right? It's more about, being able to make the right decision on when to enter a market, when to exit a market, rather than saying that I'm going to grow my wealth strategically over the long term, right? Because that confidence level, needs to come especially when, it's the investment is illiquid, right? And I think that shift in mindset is really the one that one needs to be able to drive. And I have marked personally, and of course many others might be able to comment that, those who come with strong entrepreneurial capital built over years, right? Those family offices are more prone to understand, that value creation. And as a matter of fact, like as I said, we've taken it even further to say that we will ourselves build the businesses, in this kind of an approach over the long term ourselves. So really take a 10-year bet over a business, which will, where we become, the family office itself becomes the kind of anchor, to be able to build businesses. And I think the venture out allows for a lot of that risk appetite to be kind of resolved at an early stage before one jumps to really just building businesses completely with the own family, office capital in new age areas. And I think that mindset shift takes years, and I think it requires those exits, the success, the liquidity in terms of returns and the visibility for that. And any time in any long journey, which is a 7 year, 10 year, any blip comes, the confidence just gets shaken up, right? And I think right now we are going through a phase, where again, VC funds are looking, and people are worried as to what is going to happen, and really how different boards of portfolio companies now really coming together to see how things can change. So I think these are all things that actually do not necessarily work, in the mindsets when it comes to family offices, but I see that changing rapidly.
But Chirantan, coming back to the point, have VCs delivered better than public markets?
Globally, yes, they have.
And I think that's a very important point for
Yes.
families, because when they look at VC asset class in India, right, it is a fact that VCs who have been there for a longer period of time, have to prove themselves that their returns are better than public markets over a 6 to 10 year period. And that's something very important as a question for families market to ask the VC who they're looking at.
Yeah, and I'll get to another point, which is about why it's not easy then to build a to capture that return from a VC, because it differs as an asset class from a return distribution standpoint. But yes, they have. This I found interesting. That yes, we had all of these unicorns, we had these exits, but who was really investing in them, right? From a capital perspective. I mean, most of it came from outside of India in the past, right? If you look at 2012, 17, a lot of capital came from US foreign investment. This is the VC asset class. Maybe US affiliated VC funds, places in Asia, and then of course recently, as we've all known, from China, and even within that, core VC, Indian VC ecosystem, a lot of those capital raises that have happened in the recent time has been from very few firms, right? Largely global managers, and domestic fund managers represent quite a few. And the reason I put this up is that this asset class is also about access, right? Who do you have access to as a VC firm to invest is very difficult. Some of the top VC firms globally, really are restrict access to new investors. They're closed-ended funds forever because they have one family office which has backed them, or endowments, and they don't open up their investment to outside groups. So, it becomes very difficult for somebody to access that asset class of a US VC fund manager, let's say for a family office in India, and therefore you should, keep that in mind. But I think that is also shifting. There's been quite a shift in domestic capital coming.
Well, I think that's a great point, and traditionally numbers available to us, I'll be happy to share. I think as far as India is concerned, in the last 6 years, India has absorbed a total of $150 billion of private equity and VC capital. And out of that, less than 5%, maybe 2 to 3% will be from India. And however, typically, anecdotal example from our side is that as a venture, we focused on the evangelization of the asset class in the country, and typically fund sizes for a VC like us would be $200, $250 million. That's something like 1,500 crores. My math, $250 million equivalent, and about 50% actually has come from Indian family offices. Now that's very important, because we never imagined that 5-6 years ago, when we set out to talk to Indian family offices, we would be raising half our funds from India. And I'd like to share that it's been a very pleasant experience, because the understanding of the asset class is absolutely brilliant. And typically, they seek they seek financial returns. There's no question about it, like any other LP, plus access to companies which cannot be had access otherwise. So public markets are non-technology markets. And if you give me a minute, Chirantan, I'd like to anecdotally state something which is very important for all of us. If you look at the US market cap, the 2015, the US market cap to GDP ratio was 1.4x. And in 2019, it was 1.8x. And the top 15 tech companies in 2019 contribute 30% of US GDP, which basically means between revenue and value, there's a disproportionate, inflection. If you look at the Indian market space, the public market to GDP in 2015 was 0.67, and public market to GDP in India in 2019 was 0.57. And the tech companies in India, which are predominantly the software service companies, are 7.5% of Indian GDP consistently, plus or minus a few decimals over 5 years. Now, why is this happening? And the reason why this is happening, and the US and the Indian PE markets will continue to become very expensive because there is no supply chain of tech companies in that. And in some sense, software service companies are also considered to be smoke and stack because the inflection point between the revenue and value is going down. That means, over a period of time. So effectively, there is a massive opportunity for this 7.5% in India, which is tech companies GDP ratio, to go up to 31% over a period of time. And it's important to understand that the total market cap of tech companies in public markets is 220 billion. And the total market cap of private tech markets created by VCs is 200 billion right now. And the market cap in the public market has been created over 30 years, whereas the market cap in tech private has been created over 10 years. This to me is a very telling story of how wealth creation and returns, and if you take just those two parameters, is absolutely crucial for family offices to look at, because this is a half glass full. The best is yet to come.
No, and to your point, I think the ability for family offices to then further co-invest. When you become an LP with a good VC fund, I think all of these are attractive opportunities for family offices, and many Indian family offices initially, Sudhir, and I know we used to talk, and they used to back people who they knew, right, or where they had fund managers who came in and talk to them and kind of do. So I think now the scientific approach to this asset class amongst family offices, also the availability of talent that is enabling people to do that, has increased significantly. And I think all of these are very positive trends, for the subject that we are talking about today.
Yeah, great. And I know that's very interesting because I mean, we've spoken about all the wealth creation that has happened, but how do you actually capture that? If you were to look at VC as an asset class, I think for an LP or an investor family office, it becomes really important. And I made that comment earlier about VC performing much better than the public market globally. It's the top tier VCs, let's be clear, and in markets like US and China, which is slightly more liquid. There are good signs of that happening in India. I think we are seeing, in terms of distributions, in terms of returns and what we call DPI of certain funds. But, we still to kind of see where it'll play out. But therefore, it becomes really important for you to look at it as an asset class. You don't just do VC. You don't, just as Rajan said, just invest in the, fund manager that you think is good. So there is, we're at least trying to get to a science to this. And, this is what essentially comes down to, because if you look at the US VC returns, they all depend on a small number of home runs. Right, I guess only few percentage, about percentage actually drives the real performance of a VC fund. Remember, a VC fund is nothing but a portfolio of assets, And if you look at, if you're in your mutual fund investments, they're kind of equally based, weighted in some sort of way. You will get some returns from each one of them. That's not the case in VC, for the simple reason that only few companies kind of drive returns. So don't be unnerved by the fact that a VC firm has had more write-offs. You should really understand that actually that's normal. That's what should happen. But it becomes really important to understand the why behind it. So we'll get to that.
One question, you mentioned this write-off. What is the kind of write-off you see across VCs in the US, performing VCs, and perhaps in the emerging markets? Is it how much percentage of capital? Let's say it's a 1,000 crore fund. What's the write-off percentage?
Look at it the other way. If it's, I mean, you're 100 million, just example, 100 million fund. If you're a top VC fund, you should be returning a 5x, 6x, or in that thing, right? It's not the entire 100 which is returning. It is probably the 10 million that you invested in a company and you followed on a bit, which is returning most of that. So it's skewed in that direction. Then you would assume 50, 60 to be written off zombie companies, just in the middle, 1x or things of that sort. So it really falls off from there. And that's, again, you need to have the ability to dive down and understand what those companies are, because it's, not all of them will be write-offs. Not all of them will be your 10x, 20x. There will be some companies which, will be a 2x, 3x, and that's fine. So understand the strategy of the fund. A consumer fund, right? Typically, you would just have one or two companies which drive everything. That's been our experience in China, for example. A B2B tech fund, perhaps more distributed, right? The exits will be more the high, yeah.
And in India, I mean, we've seen write-offs at 20 to 30%.
Yeah, it's not as extreme, I'd say, in India. Yes.
But it also re-emphasizes the point, Chirantan, that having fund managers who have access to good deal makes it that much more attractive, especially given this is what you're saying, and we see that in Western markets and India as well. So
access is
yeah, there are some things that what do you prioritize, right? When you're choosing a VC fund, I think that's important.
Oh, it's really difficult because you're trying to establish who to invest in a person who, also does not know, perhaps, or articulates in the best way of what that person is investing in. You go to a VC fund and, what's your strategy? My strategy is to back the best founders. Like, so try saying that at an investment committee, right? But so you have to really, try to dig in. It will take time for a market like India to get to that level of where you can just, objectively, slice and dice and figure out. But there are ways that you could do it, and we'll talk a bit more on that. And again, coming on this write-off point, even the best funds, right? This is a very interesting chart I found where, the top-rated funds also have more strikeouts than mediocre funds, right? You look at the number of percentage of money-losing investments on the left-hand side, it's quite high. So it's not that, if you're one of the top US VC funds, you're not going to make mistakes. You will make mistakes. Just be cognizant of that. This is an oft used kind of thing of dispersion in VC returns. And this is where manager selection is critical. And I just want to say, this is a US example. The dispersion of returns in India are much narrower. If you look at all these years, right, the top quartile, the difference between the top quartile and even the median is pretty high in terms of net IRR, in terms of the returns they're giving. So that just tells you that you have to back the best to get access to the best. So it's a big, what we call as a virtuous cycle in venture capital. This is not so in an asset class, say, like infrastructure, where there's reasonable amount of coalescing around one certain net IRR. So dispersion is very, very key here. And we'll get to why that is. So, hooray, how do we actually try to make a selection now that we have all these kind of things and peculiarities of an asset class, which sometimes, at least in the Western world, is notorious for not giving that much of information around returns. So how do you actually do that? Look, it's as an LP, as CDC, we have quite a breadth of institutional knowledge within CDC. People who've done this, far more than I have, and essentially it all boils down to the skill sets around what we look at from a private equity fund and what is different from a VC fund. So maybe let me just spend some quick minute on this. What is same from a PE fund perspective, team skills, bandwidth, of course, you need to have the investing experience. You need to have, operating experience may not be key. You need to have significant board level involvement. And that applies for VC funds as well. Team stability, how often have, the investment team turned over? Have there been departures? How consistent is your strategy? Are you at an appropriate fund size? Are you a really tiny fund, which is like a 10 million fund, and can you really capture those opportunities? And what is alignment, right? How much of a skin in the game does a general partner or a VC have with the LP? And we can unpack these in a bit, but what differentiates this is from a VC fund is firm brand, right? And it's a very funny thing to say, because you don't, typically you say, you don't just back brands, but surprisingly, brand ultimately is a function of what the VC fund has delivered, the access. The best founders will come to you if they know that Chirate has backed people in the past and has been successful, and they actually see it. You will get them. You don't have to go hunting. So, that makes it really important to assess that. How we assess it is more an art than a science. I mean, it's all about understanding people in the market. You have to kind of speak to people. We speak to, we get a lot of requests from family offices that we are co-investing with alongside our funds who want to understand, our views on them. So I think, I'd encourage you to always speak to people about what they think about their brand and track record. This is a very interesting one, because I think in India, we have slightly less of that, across, right? It's not as standardized. So we do tend to look at a lot of, follow-ons. Who are you getting into the companies? Who are the quality of investors that are coming into the companies that you have? You may not have returned, but, is there an uptick in valuation? And who is driving that? So if you have people coming in, investors coming in who are, no-name, mid-tier investors, is that really something I should rely on your track record, right? Vis-a-vis a really reputed US VC or a large investor coming in who knows what they're doing and who knows what they're pricing.
One question, I think this is very interesting. I mean, there are many VC funds now in the country. Some of them in the fourth fund and third fund. Some of them are starting up. Now, a firm cannot develop its brand in the first fund. Okay. So first question is, how does a family office choose? Should they do first fund, second fund, third fund? Because by this narrative, family offices should only invest in third funds. And the reason is because by the time the VC invests, by the time the VC comes up with a second fund, there will be no returns in the first fund because the time cycle would be much different. So any comments on how the family office should choose between fund managers who are starting off their first fund, second fund, third fund? How should that be construed?
Sure. And I think, not a straight answer, but I think it falls down to portfolio construction, right? And don't think of this as your only bet. You have $1 million that you want to deploy to this asset class. Do not, just say, that's it. This is the one fund I want to back, unless, you have complete conviction around it. But it's about, what strategy what do I want to get out of this? Out of investing in VC? What's my investment objective? And I keep coming down to that, because unless you're very clear on what your investment objective is to build a VC portfolio, it's just useless. You'll be disappointed. You will not know what's happening. There will be downturns in the sector, as we've seen with COVID, etc. So you really need to understand, okay, my investment objective is to, I'm in the manufacturing industry. That's where my family business is. I need to understand what's happening there. Should I be backing a consumer firm? Probably not, right? You can for diversification purposes, but I want to be able to back, deep tech firms, firms which target that kind of segment, and let me spread that across. And you will find early stage firms, VC funds who have done that. We have backed early stage VC funds, and that becomes interesting on how we evaluate track record. I think we evaluate not the brand, but the reputation, right? Those are two different elements. A reputation is how, if there is a deep tech, company entrepreneur, is that person going to come to you to, talk about the deal? Because you have a reputation to really understand, evaluate deep tech, whether it's AI, machine learning, right? Or a track record is, have you done something in the past where you can demonstrate to us that you will know how to select the right companies? You have that discipline. Maybe you were an angel investor, right? Maybe you worked in a firm which kind of did that. It's hard, and it's a higher risk for us as an institution to bet on that, because investing as your own versus investing as a fund manager are two different skill sets.
Right.
And Sudhir, this, we've talked about this a lot, right? Institutionalization is key. So our bet is, how certain are we, or how, that this is a team that can institutionalize. First fund may be proof of concept. It's fine. We want to back it because we really believe these are the people we should back. Long-winded answer, but I think understand that you may have to re-up in a second fund. All your returns may not be from that first fund. You'll be lucky, because not all first-time fund managers actually make it. The real returns may start coming in from fund two onwards.
And like in tech entrepreneurs, there is a mortality rate. Have you seen mortality rates in first-time funds?
Pretty high.
What does high mean?
So we've seen this actually in the private equity asset class in India. I mean, if you go back, right, the funds which were launched, in the what we call the small cap SME space, there were a lot of GPs out there. Most of them don't exist anymore. So either some have become larger, private equity funds, or some have continued on. I think it will happen in Indian VC as well, and will happen, continue to happen. You will see some funds not continuing because it is difficult to raise capital, outside India, for example. More so, early days, but yeah, there will be mortality. I think people have to figure out whether they have to merge with larger firms or come into a new avatar. But yeah, that's a risk we know what will happen.
So I think what you're saying is important to give thought to capital deployment by family offices. If it is first-time managers, which is perfectly fine, to also the discussions on institutionalization, discussions on portfolio, the depth discussion, and have a science, somewhat of a science behind evaluation. Rather,
Yes.
I think, as Rajan said, I know this person, and to that extent, it's a good bet.
Remember, it's a 10-year asset class. You're locked in for 10 years.
You're locked in for 10 years.
You're locked in for 10 years.
To this, Chandan, and Sudhir, you made a good, so how does it happen, right? Because this one person someone knows, then you talk to two other family offices. So I've marked in first-time managers, there's always a lot of discussion amongst family offices, about backing. So typically it always becomes, at least the way we see it, like a family office consortium, different family offices coming together, and it takes that much longer, right, for that first-time manager to really win the confidence, because it's a slow process. What you rightly said, you're evaluating reputation, you're discussing with many others, because you might like the theme, you might be interested in what that area is, but this is a big part that this risk you got to mitigate through other ways. And I think we have some formal structure also which happens as discussions amongst family offices. And it's very interesting how, that those conversations actually become the basis for making that investment. But I want to push it back to you, Sudhir, a little bit on this topic. You were also at one point a first-time manager, right? So what did you pitch? Or you didn't have family offices, and that's why I think in India we find that the first-time managers normally skip family offices, and therefore later on for them to build LPs with family offices takes that much longer because they never had them in the initial first phase itself. So I don't know. Maybe that's an interesting point for us to talk about.
So I think it's a good question, and again, for me, it's very important when we start. I mean, I was in the VC market. I started investing in India in '98 when there were just 4 of us in the whole country, and to some extent, my case would be different because we had invested. I was the country head for Walden International, and to that extent, that experience paid off. But I think when we started raising capital in 2006 for our, what used to be IDG and now Chirate Ventures, at that time, there was no family offices in India in the context of what we are talking about. So for fund managers at that point of time, the bigger asset classes and capital pools were outside the country, which is what we did. However, I think things started changing around 2013 and 14 when the AIF structure came into the country, and angel investing had already started at that point of time, a few years before that. I still remember in 2007, when we made our first investment under Chirate Ventures, there was a total of we made a count of angels in the country. And that time, Rajan, there were 220 angels in the country. And today there are over 10,000. Okay. So effectively, the angels used to be let's say the proxy for family offices at that point of time. I think today when there is the mortality rate in VCs is actually very high. When we started, there were 12 or 13 of us who raised capital. And today out of those 12 or 13, only 4 or 5 are left overall. And maybe I can pose a question which after I finish, Chirantan can answer. Why is there mortality rate apart from performance in funds? And family offices, to my mind, should think about it, because at the end of the day, first time managers do bring a lot of value, by the way. So I'm very clear. I mean, I was a first time manager at one time, and I thought my pitch deck as a venturepreneur, I call ourselves, was the best in the country, because we brought differentiation, we brought a new way of thinking to venture capital investing and so on and so forth. So there is no straight answer to this, but it's very important to fundamentally see, in my mind, whenever family offices talk to us, is there a science behind venture investing, or there is none? Because I think it's important to have a science behind venture. In fact, it's important to go through their PPMs. It's important to go through the portfolio construct, as Chirantan mentioned. It's important to see, are they reallocating money? Are they allocating money for reserves? Even first-time managers, they must have a science, and that is something. Yep. It's like, is there a list of 25 questions which family offices who are not invested in VC funds should ask? The answer is there is a list of 25 questions, right? And that list, by the way, I would encourage the family offices groups to have, and we'll be happy to put it together for them and saying, hey, you must ask these questions, because that is your safety net. It is not, I know you.
And that's what led to these single family offices moving to multi-family offices, globally and everywhere. I think that is what you're absolutely right. I think that scientific approach is probably that will enable this investment class for family offices to grow much better. Yeah.
Right. Okay, back to Chirantan.
Yeah. And interesting, because as an organization, right, CDC, CDC has invested in India since quite some time. I think we've been, as a firm, we've invested in about 45 fund managers in India, approximately 2 billion as an LP, and a larger number in Africa. And there are many institutions like us, such as the IFC, such as other development finance institutions, and you can imagine. Now we've kind of distilled that, right? I mean, of how do we evaluate this, and at an investment committee, I can't just show up and say, I like this fund, right? The biggest question, I guess, and it will go to mortality, Sudhir, that the question that you asked, because of our experience, combined experience, we've found is team stability, GP, alignment. It's stuff which is not related to the investments. It's how do you ensure that this person is going to be committed to a very high risk strategy, for a very long time, and managing other people's money, right? So it's, how institutional is that person? How aligned are they to this? Is this their only bet? Have they put in quite a bit? So you can figure out, you can kind of try, having benchmarks to say, look, if you put it, what is the right amount of skin in the game, right? GP commitment. How much of your net worth is is a GP commitment? You may be a billionaire and you have just a small thing, right? So all of those things you have to really understand. And team stability, team building are things which are absolutely critical. I think the biggest failures we've had and many others is because of is on team stability, right? I want to kind of take on to this slide shared to be by a colleague who's done this, who's done fund investing for ages, especially in the VC asset class. And from her perspective, I think she calls it the venture capital, the virtuous cycle, right? It's funny because you have to a VC has to has to have access to the best deal flow in order to generate the best returns, in order to develop the strongest reputation, in turn, which will attract the best entrepreneurs, which will give you, again, access to best deal flow. So it's a cycle. You have to keep doing that. And I think that's what drives a venture capital firm to be in the market, right? To be out there, to be known. When you ask folks around, who's the one I can turn to understand, SaaS businesses, to understand consumer businesses, etc., right? And so all of them have generated. The reason you hear a lot about, Sequoia, Andreessen Horowitz, Excel, etc., is because they've had that. You would a entrepreneur would want to have such firms on their on their cap table. So half of your kind of job is done. So it's very important about individual reputations. This is very unlike private equity. Yes, there are private equity. There are brand names, the big ones, global PE firms, but they don't necessarily attract. Companies don't get attracted to them as much as a entrepreneur who really needs advice gets attracted to to having Sudhir on the board, for example.
So Chirantan, very interesting. This slide is very interesting because I think the dilemma, if I may say, for Indian family offices is that if bulk of the capital which is provided in the venture space, is dollar capital, fundamentally, the opportunity to invest in those dollar capital funds is not there. So what's there is Indian funds, and Indian funds will be there, and the pyramid will be, there'll be a lot of funds who are first time managers, and there'll be a next level who will be second time, there'll be a next level, and then there's a pyramid who will be, fourth and fifth fund. And so to that extent, I think it'll be very important. And by the way, these fund managers who've been around for, let's say, 1 to 2 to 3 years to 15 years, right, would have gone through these venture capital virtuous cycle in some form or the other. And, so I think the opportunity for Indian family offices is to invest in Indian venture funds.
Yes.
That, to me, I think it's a very strong opportunity. However, if you compare it to the fact that there is a Sequoia or as you mentioned here, or an Axel or an Andreessen Horowitz, Indian fund managers obviously will be building their reputations, right, in that space. Any comments on that?
There are good examples out there of domestic firms which are built at. I mean, of course, your organization clearly, but don't forget, it's not just a Sequoia who's going to take the deal. A Sequoia would want to work alongside some of the domestic fund managers.
Yeah.
Right. So you need to understand how do you work with some of these US affiliated firms, right? And so when I'm considering, when we consider an investment, we also look at how do they get along? Who do they co-invest with most often? Because it's not I don't think in India we're in a place where it's just one VC firm going after one company and then just holding it for themselves. It's a very collaborative market. And I think that's something you should understand. Like, yes, you may not get into access to a Sequoia as an investment class, but that does not mean you cannot get access to their investments, which probably some of the other domestic firms must be also getting access to.
Yeah, absolutely. And I think the other thing which is there is that since anyway international capital is, as one of your slides showed, a bulk of it, it may be worthwhile for the fund manager, for the family offices to actually have a parameter that, look, the funds which VCs raise are domestic and international capital, because that will give them a view of some sort of diligence which has been done by international firms on the fund manager. And the quality of those LPs in the international side, in some sense, would that be a reflection on the quality of the manager for India? For
Yes.
Indian family offices?
Yes, yes, yes. It's a good sign because remember we, in an institution like CDC and some of the other, kind of LPs who do this, it's their job, right? As large capital providers, and they, for whatever sense, have got tried to at least build a sign sort of. So yes, you can get a lot of comfort, and you should kind of reach out to institutions like that. If there are family offices, and we've done this in the past, who've asked us for references on funds we've invested in, and just to give a perspective, right, of how we're thinking. And yes, that is a very big signal. We look at that as a signal as well, as to who else is excited about this. There is, and on the other extreme, there is a herd mentality, which you'll see in some of the larger funds, where everyone's on it, we have to be on it. We're not in that space yet in India, of course. But yes, having some of the larger names, that the LPs, global LPs, would help.
But
Certainly.
one question which I thought I'd ask again is, and again, the amount of diligence which family offices would do, and Rajan, maybe you can answer that also. References, calls, etc. Do family offices who are investing do a lot of diligence in the country?
So, as I said, I think there are some key things that people look for, or family offices look for. And as I said, I think there are again a differentiated set of family offices, right? Some who would hire professionals, look at all of that, and they're building in-house investment structures, infrastructure that can enable them to make these decisions in a more scientific manner. But largely, I'm telling you, even here, it's a lot out of conversations. It's out of, like what you rightly said, checking reputation, seeing the returns that you have made in the past, if there's a track record, and actually working with the collective mindset across family offices. And I'm sure you've seen that. And I think one other point related to what we were discussing is that Indian family offices have had a limitation to what they can invest overseas, right? I think even today through AIF, there's a certain percentage that through the funds they can get exposure to international investment. So I think that has also in a way kind of being I don't know whether it's good or bad, but going forward, at least the way the conversations are happening today, we want to see great Indian companies built out of Indian capital, being backed by larger family offices. I see that sentiment, beginning to move today. And especially when there is certain types of capital that the country is kind of talking, how are we going to look at the growth of the industry. Indian family offices are actually feeling that they could and are probably been through that learning curve and looking at putting more money behind that. And again, as I said, it is a challenging time because there is a lot of liquidity. I think just this morning we had the National Council we were discussing, and KV said the amount of liquidity available in India today compared to the 2008 or 2009 crisis is like several fold higher, right? So that wealth is there, the money is there. I think it's just about bridging the gap to move money into VC and into these asset classes. So I think we are better positioned today to see how Indian capital can come into this space. I just wanted to add that.
Chirantan, I want to ask one question, which I think will be very relevant for the family offices who are on today in this webinar. How much time do you spend in diligencing a VC? Is it 2 calls, 20 calls, 3 months, 6 months? How much time do you spend? I think that's very crucial and what do you do broadly, the 4 or 5 categories of diligence as such?
Sure, and I think I'm sure we've been through that whole process with you for some time. So, but a lot of time, and it's so surprising. It may feel as if, oh my God, that's really intense, but it can go on for 2 to 3 months just to really understand the strategy. Look, this is it's a very difficult asset class. I don't want to not say that it's a risky asset class. So we are trying essentially as LPs to get inside the head of the VC. Right? What's your strategy? You can have the best kind of strategy decks, and here's what we've done, but really want to understand what learnings you had from your mistakes. You say you're going to reserve. Did you actually do that? How did you behave in board meetings with your founders? You are not going to back all of your founders, right? You will take a call on the ones you want to back. So how do they feel about it? It's a lot of heavy reference calls. Heavy. I mean, in certain cases, we've done up to 40, in some funds, because it's not about that we can't make up our mind, but I think we're all trying to triangulate towards certain things that we don't miss out. And these reference calls are not, what you'd expect us in the standard way. Hi, do you know them? What do you think of them? Great, thanks, bye. Right? It's very conversational with some of them. I think the references also, are more open to share, with us. But if they're founders, as an LP, they'll be more open. Please do a lot of that, because only then can you really understand what the the need of that product, the reputation of that team, and how they behaved if they have invested in the past. So quite a lot of time. Look, as every institution will have a different timeline, right? As DFIs, of course, we have investment processes. There are multiple other teams that get involved for CDC. We have very strong kind of a focus on ESG. We have very strong focus on development impact. So just trying to understand that. So that takes time. But from an investment team perspective, we really want to kind of engage very early on. I don't think we've probably made an investment into a firm who we've just known, let's say 6 months back. So we've known each other for a very long time, and only now have we kind of looked at it. Right? So it takes quite a lot of time. I also, sorry if I've not answered that, but Rajan's point on domestic capital, that's very, very important. At this point of time, you have a regulation which is enabling for, as an Indian investor, look, we could come in from different structures as a global firm, but you have the AIF structure, which is pretty well defined. SEBI regulates it, and it's very, very stringent. So it protects the rights of the LP. So I think I would like to see more of that domestic capital coming in. I mean, this is what happened in China, right, with renminbi funds, and it's surprising because why should you have foreign capital in a company which backing Indian companies and Indian founders when you know them, right? I'm sure as family offices, that founder through some connection. You should be able to say, actually, I back this, and I'm going to invest in a fund to do it. So I think there's a very logical reasoning why domestic capital should back domestic VC funds.
No, and the other interesting point is you're absolutely right, and I think the diligence that family offices can rely on or is doing a lot today is where institutions such as yours have invested in, right? Because you talk of this elaborate diligence process, and family offices actually look at which are the other institutional investors in that fund and relying a lot on that diligence. If many of them don't have the ability to to kind of have all the processes in house, but this is a good case actually for increasing just the amount of sheer capital that can come in from family offices. From a timing perspective, I think this is a good timing.
Okay.
Yeah, and I think maybe we spend some time just on these two slides, right? When I spoke about characteristics of firm brands, and I think after this, I'll just kind of try to give you a view of how we thought about it as a firm to build out our VC portfolio. So again, firm brand, access to the best deal flow, what kind of connections you have with the entrepreneur community, how do you actually gain sight of that deal, and can you actually secure that deal, right? So one is that, because that is part of the access and the portfolio makeup. So you may get into the greatest deals, but have you got into the greatest deals in the way you want to get into? For example, are you a very small investor in an amazing deal? Is that great? No, not so much, because you might actually get diluted down the line, right? So that's when you start talking about the ability to actually follow on in those rounds. Track record is quite interesting, because the way track records are, and this is my own view here, is shown in VC funds is, look at our IRR. It's amazing, which is great. You can't really eat IRR. So we'd like to prefer looking at what we call, multiple on invested capital, or TVPI. How much money on cash on cash, or money on money is that fund generated, or some of the investments generated. So IRR is not kind of giving you the complete picture. So don't just get, I guess, seduced by a pretty like 70% net IRR kind of point there. The next slide, again, fundraise and fund size, and I kind of alluded to this at the back. It does not matter if you have the greatest access to the greatest firms unless you don't have the ability to really back them, right? So sure, you got 2% in the earliest stage round in when I don't know, Flipkart or some other unicorn was there, but you would have been severely diluted till the time it became what it is today. So do you have that ability? Do you have that discipline to actually follow on? And do you have the fund size to do that? Now, if you're a 10 million fund, if you're a small cap fund, you better know and should be very clear on how you're going to generate those returns. Micro funds do work, right? You have to have a different strategy for that. And that's what some of the larger billion-dollar US VC funds do. They have the dry powder to kind of keep following on in their best companies. So you need to establish that and really understand that from your GP when you're talking to them. That do you have the ability to do that? Management team, of course, is very very important, because you need to figure out what skill sets are there in a VC firm. Is this just one partner? Is this are they two partners? What do they bring to the table? Are they complementary? It's a pretty heavy effort for early stage VC. You're investing in companies which probably doesn't have a CFO, probably doesn't have all those MIS systems. You have to do a lot of that, right? So do you have that capacity? So you may see some funds, actually smaller funds, having a higher management fee. Your instant reaction should not be to balk at that number. Just understand what the budget is for that, right? We've seen cases when smaller funds which have 2.5, 3%, but there's a reason for that. And so, you need to look at it holistically. And the last one, which is quite interesting but the hardest to get, is investment strategy. How consistent, disciplined you are, and how much time you spend on portfolio construction. Now, consistency and discipline, may for some VCs sound like, God, you're just killing my mojo, right? I don't want to define myself as this person, but it really matters. I think some of the more veteran VC fund managers have realized that you can be as aggressive and as venture-like, but you need to have that discipline and consistent. What are you really backing? Are you backing the best founders who are building global businesses? That's a strategy, right? So all of these things, I think you have to start getting comfortable around that, and question the manager on this. We spend quite. I'd say I've had instances in during due diligence where we spent 2 full days at a manager's office just on investment strategy. I have the deck in front of me which says what that is, but I really want to understand what that means. Have they done that in the past? How real is it? You say you're going to target the consumer consumption growth in India. Okay, that's a theme, right? That's not a strategy. So just you have to kind of really spend time delineating that.
Yeah, I can tell you from the other side, as what VC typically would do as essential. These are like hygiene factors. Focus on team and stability, governance, focus on deal sourcing capability, focus on how to build portfolio, subsequent rounds of financing and scaling, focus on exits and track records. Is there a discipline to exit? Um, as you rightly said, fundraising. Can I actually close a fund? Because that's very important to LPs, which also decides, by the way, whether a family office should come prior to first closing or subsequent to first closing, because many a time funds don't close. What's the quality of LPs in India and outside India into the fund? That's a very good. We try to build quality of LPs because we like engaging. What's the value add to portfolio? Diligence. Many of our LPs do diligence with the portfolio. So there are, like, say, 4 partners. All those 4 partners are sitting on boards. And it's important that a family office talks to those board founders and say, what did these guys do for you? And that alludes to one of the earlier strategies, earlier slides which Rantan you presented in terms of the value add. What's the portfolio construct? What's the stage strategy? What's the sector? I think there's a list of 50 questions to be asked. Maybe Dhruv, I can ask you, to put together those 50 questions and send it to all the family offices. I'm sure they know it, but still, because those are important part of the diligence. And don't take a decision in 1 week. There is no need. Take a decision in 3 months. It's okay overall. So maybe we can take a pause here. I know Dhruv sent a message that, hey, we are running late. We have only 10 minutes to Q&A. So Chirantan, Rajan, is it okay to just go through Q&A right now?
Yeah,
Yep.
I think so. Yeah.
Let's do that.
Okay. So
I'll stop sharing.
Rajan, you want to go through some of the questions?
Yeah, there was one which says, from LP's perspective, which are the sectors, maybe one or two, one would like to focus on for the next 2 years, and any views on the Indian gaming sector. And so I just take a little quick thing, because we are deeply invested in the Indian gaming sector. As a matter of fact, we own a few companies which we have, operationally grown across, casual gaming, esports, PC gaming, and all of that. And our bet on the Indian gaming sector is significant. I think it's a very rapidly growing business, and it's still a very small percentage of the $150 billion global industry. But I think there is an opportunity. Even the government is aligned. As a matter of fact, I am the president of the Indian Digital Gaming Society, which the Confederation of Indian Industry has put up together, to see how the entire engineering, art, product design, all that can become part of global supply chains when it comes to gaming, animation, and other sectors. So it's quite a thing. But would love to understand, Chirantan and maybe Sudhir, 1 or 2 sectors that you think are the other ones. Deep tech is another one for us.
Sure. And as an LP, just let me attempt that a bit. We don't, and it's hard to do that. We don't go with, I just want to do this sector, because actually we're not there yet as in India, where we have sector focused VC funds. Like, yeah, there are funds which focus on, let's say, food and ag, deep tech, right? But they're still broad. So for us to say, I'm just going to focus on logistics VC funds, there aren't any, right? And jury is still out whether that specialization, we are at that stage for, to deliver that. So we have themes as we look at. So if my theme is, as CDC, as a development organization, if we want to back funds which have the ability to, back companies which are serving the masses, which are building SME business, MSME businesses, that is an area I can go in. And then that's how I start building my thing. So I don't think as an LP we would have that view. I think as a GP you'd have a view on sectors. I think you asked a question on gaming. Again, that's too specific for a GP to ask, LP to kind of say, I mean, I would love to. I'm an avid video gamer, and Rajan, we should talk more about gaming later. But
So, maybe I can just address one question that is from to Charantan. Um, what have you seen in India? And I'll probably answer that question after you. What VC themes are shaping up post-COVID, and what opportunities are LPs excited about in this asset class?
Sure. I think uh, the whole healthcare, online healthcare, the whole logistics space, the whole as you know gig economy in some sort of way, those kind of at mass education, for example, which were already good themes earlier, right? I think what COVID did was it just accelerated that pace of change. Like immediately, you had online consultations, which were a thing, but suddenly everyone is just doing that now because that's where the customer is, right? You had e-commerce. I think Sudhir, you may know this much better. The percentage of e-commerce in India, right? It's quite low,
Yeah.
and suddenly it's just gone. So a lot of adoption, a lot of behavioral changes happen over that education. It's now okay to school people through an online channel. I mean, we are on Zoom now. We'd be in person talking, but so it's become much more normal. So I think those have worked out. So as an LP, I'd say yes, anything which is about digitization of a traditional sector works, and I think that's where the opportunity is also there.
Yeah. So maybe I can just add to that. In the month of March, and this is the extent of COVID impact, and I'll be happy to share that since this is a closed room. The total revenue of all our active companies was about 7,000 crores annualized in March. It fell 65% in April. And in July, it's back almost to 7,000 crores again. Now, trust me, between March and April, we were pulling our hair. We were pulling our hairs, entrepreneurs were pulling their hair, because this has never happened. And this is my fourth downturn. This is a different downturn. Multi-dimensional, health, travel not allowed, stay not allowed, everything going digital, everything going online. So I think what we saw in that first 30 days was amazing quality of entrepreneurs. Because, when your back is to the wall, that's when the high quality comes out. We also saw new business models, new products. One of our companies advanced a product to be launched in October to April. It was a technology product as such. Fundamentally, what did we see companies doing? We've always invested in companies to solving real problems, becoming dominant in India, and then going global. So this has been our theme. But fundamentally, in the April, May, June timeframe, we saw more digital, live classes, live doctors, live fitness, etc., etc. We saw more online, and we saw many of our companies going more global. Okay, today, FirstCry is in Middle East, Lenskart is in US today. It's selling in US. And this has happened during COVID times. So the answer to this question is very interesting. The GP sees it as an opportunity. So does the entrepreneur. The entrepreneur says, and obviously it is dependent to some extent on capital availability, but most of the companies went straight in the first 30 days, focused on their core business, cut costs so that they had capital out, survivability for a 10, maybe 12, maybe 18 month time frame, maybe more. And then they started saying, now I know how to survive, let me see how I can grow. And I think that fundamentally is very important in a technology company. Because if I look at the traditional companies in the country, right, rural demand made two-wheelers pick up to almost normal in a 4-year time frame. But that's nothing to do with the product, by the way. It has everything to do with demand. Whereas a tech company goes and creates a demand, okay, which never existed before. Work from home, today you have millions of people, right, using CureFit fitness classes at home. You have millions of people having live consultations at home, deliveries at home. The payment aspect, digital payment shot up. Even in farmers, by the way, okay. We have a company who is looking at how to do crop productivity through satellite, and they shot up in terms of B2B companies. thought about how to close businesses because they can't travel. Traditional was go and meet the CIO. How do you close a business in B2B digitally? So much of innovation happened. And I think that is very fundamental to the technology world. And that's the changes we saw. And that's the changes we are looking at right now. Some of these are going to be permanent.
Hmm.
So today we are thinking, okay, what's going to be permanent, right? What's going to be non-permanent? Do we have to change business models again? Which product, which was pre-COVID, is non-essential right now? That means it won't survive. VC also has to think what to kill fast, by the way, because
Yeah,
if you don't kill fast, right, we could be just burning money.
true. And
Answer.
one thing I just want to add that's a very interesting point of the digitization. Yes, there will be some things which will digitize faster. And I come back to the fund construct again. The fund you're going to invest in probably will have a 4 to 5 year investment horizon from today, right? If you're starting off from tomorrow. There are certain things which are getting accelerated, but certain things will come back. So don't, think that ride sharing, for example, it's a big no-no now. Don't think that's gone. That will come back because there's a fundamental need, right? Education tech, online education is great, but people are being forced to do it as well, with their kids at home, etc. So, there will be schools and there will be different model on offline models. So it will happen and over the horizon. So I think digitization has really come in, is here to stay. Some things are permanent, but some things will also perhaps go back. And, it's that kind of conversation I think as a family office you should be having about strategy with the fund manager. Not, yes, you say digitization, but is it going to change? Is it? So I think that's just part of. I've just reminded as part of stuff you can talk about in investment strategy.
I'll just add. Go ahead.
Sorry. There's a question from Java Capital. What has been the typical multiples in India across vintages since 2006, when the VC cycle started in earnest?
Trying to recollect. As an aggregate, it will be quite low. It is quite low. Again, the top ones we've seen returns of 6x, even higher. And I'm, in some cases, excluding the US VC firms who operate in India. So I will not be able to give an aggregated view because again, it's massively distributed. It has kind of come to a point where that is low, that distribution is low because even some of the domestic fund managers are, on top of that. I mean, like a 1.8 to 2x kind of returns are being tracked. You should look at DPI as well in certain cases, not just the multiple.
Yeah. So I think it's a combination of DPI.
Yes.
It's a combination which is exits in terms of
Yes.
cash return, your cash IRR, your unrealized IRR,
yes,
which is there. And those both are important. Average holding periods, winners backing. So I think it's a combination which is there. But
yes.
I think one small answer is I think it's not about. I mean, there are over 100 VCs in the country. I know, for instance, SIGBI is a very well regarded LP, which is a proxy for a sovereign fund of fund. And my understanding is they've invested in over 50, 60 fund managers in the country, but many of them first time. So I think if you have to just look at people who've been around for a longer time, you'll probably find some very good reasonably good returns.
Yep.
There's Rajan, when I interrupted, you wanted to say something.
No, go ahead. I was just picking some other questions. So there was this question on whether family offices should invest in Indian startups that have global customer base. I think it's very obvious because the realization of global customers is that much higher than things. And I was just going to add a comment to the COVID question. Given that the new normal, which one talks of, when we saw demonetization, digital payments went up 400%. The new normal was a 200% jump from where it was, right? I think this time, while we talk of new normal, another way of looking at it, and this other discussion is going, it's a never before normal, right? Because I don't think one has anyway seen such a thing at the world level, and the uncertainty that goes there. So I think the point that, Sudhir, you were talking, and then Chirantan also agreed, that this is a time where one can really pick, good opportunities based on certain types of trends that will sustain irrespective of what happens. And there is an opportunity for, a massive shift in consumer behavior happening at a much lower cost today, to companies that are already invested in those areas, right? So, and I can tell you that we are seeing that in some areas where, the amount of capital that would have been required, the time it would have taken, to get to positions that are 18 or 20 months ahead are happening in a matter of compressed, accelerated thing in 2 months and 3 months, right? So being able to pick that gives an opportunity which is very different today. So I think, a discussion for family offices to have with VCs and to really look at, this entire space in that light is something which is pretty interesting.
Maybe I can ask one last question. I know Dhruv is sending messages and we don't want to wrap up. But one question, and after Chirantan, maybe I can chime in last. But Chirantan, there is a question on how should portfolio allocation be done between co-investments with the VC fund versus investing in the VC fund?
A great question. I think, yeah, we do that a lot. We look at a pot of money for a fund investment portfolio, and I wish we had time to talk more about that. But essentially, across stages, across vintages, across strategies, is how we try to build up a VC portfolio, funds portfolio. That has a certain pot of money. We also reserve a separate pot of money for co-investments, right? To invest directly into some of the companies which we think, and for CDC, which we think have the highest development impact, right? So that's our criteria. You must kind of delineate both, but you must identify as well. And I think that's a great conversation with a GP to have, saying, look, I'm investing X in yours, but I would want to keep aside X amount for co-investments. That's also a good signal for you to pitch yourself to a GP of why they want to have. But yeah, that's how I look at it.
Add to that, this is a very good question, because why is their co-investment pool is very important. And what is the targeting? Fundamentally, co-investment pools demand higher pools of capital to be invested in the VC asset class. I think that's a fundamental. So if you're investing 5 crore rupees and 5 crore is another hypothetically additional, which is for co-investment, it may not work, because then let's say you're in an early stage fund and the allocation to the fund is 5 crores. And with the 5 crore, then are you going to be investing as a family office into early stage again, or you will be investing in late stage? And that's a very important question, because I would submit that if that 100 rupees is coming into an early stage fund, then the early stage risk has already been taken in the fund. There is no need for co-investment to be again in the early stage, because that is double whammy as far as risk is concerned. So how to construct a co-investment strategy is an important part of GP. I have seen many times investors, coming back and saying, hey, I've put in 100 rupees into the fund, but I find this great company you invested in, give me a pool of it. It doesn't make sense to me. The co-investment pool, the ratios could be 1:1 between fund and or 1:half, it doesn't matter. The co-investment pool should be addressing a different asset class in stage to de-risk your main investment into the early stage. And that to me is the best way of working.
Absolutely. Do not second guess, let's take an example, and this is how we look at it, right? We invest in VC funds at the early stage because we don't have the capacity to look at a Series A seed investment, right? We're a very large organization, but we don't have that. Why repeat it when we can do it with some successful fund managers? The co-investment program for us is for later stages, right? And that, I think, Sudhir, I agree with you, and I just want to make clear for everyone, co-investment is not at the same time.
Yeah.
It's not at the first check. Let's say Chirate invests in a company in seed. it's not a great idea to go in at the same time as them. I think watch the company grow. You have the benefit. You're paying somebody to do that, right? To take it to Series B, C onwards when most of the risk is out. And that's the time you should come in if you're interested for whatever strategic reasons, etc.
Yeah.
Not before. Otherwise, why bother?
Yeah, why bother? Excellent. Listen, I know we are way out of time, but a big thank you, Chirantan and Rajan. And I'm going to have, this has been a very interesting conversation, and I hope the audience found it very useful. Whenever I talk to Chirantan, it's amazing. I always learn something more. And Rajan, of course, has been a friend for some time, and always good to hear the family office point of view, and an entrepreneur, of course. I'm going to hand this over to Dhruv back. Dhruv.
Yeah, hi. So thank you everyone. Thank you all the attendees, Chirantan, Rajan and Sudhir for taking out time for this interesting session. So we'll be back with the session, similar, we will continue the series and we'll come back with the third edition of the Family Office. You can, get an update through our LinkedIn page, or we'll send you the invites through our database which we have built. So thank you so much everyone for taking out time, and we have recorded this session. So we'll share the session on our LinkedIn page and at various channels. And we have got your story to cover this session. So thank you to your story and Shraddha for supporting this initiative. Yeah, thank you so much, and
Thank
have a
you.
great evening.
Thank you, everyone.
Thanks.
Thank you, Dhruv. Bye.
Thanks, Dhruv.
Thank you.